What's up, guys? This is Casey, and welcome back to the channel. So today we are going to be reviewing the stock market, specifically the SPY and the QQQ, because I think we are at an inflection point right now to where the markets are about to make a significant move, more so than what I think they have made in the past. And today we're going to be discussing why, what I think it's going to do, and what I think you guys can do to make some money. So let's tune into this. So without further ado, here's where we are. You are looking at the QQQ and you're looking at it from the maximum time frame. And what we're looking at here is we're trying to identify the last recessions that we've had in the markets. Now, whether you guys are like 18 years old or 60 years old, if you're looking at the markets right now, you'll see that we have only had two recessions since 2000. So in the past 23 years of living, there have only technically been two recessions, not counting this one. This will be the third. Now, if you look online right now, you will see a lot of financial analysts stating that they think that we are in a new bull market. I think that is ridiculous, absolutely ridiculous, and I think they're setting you up to steal your money. I'm gonna tell you why. If you go back and take a look at the last recession that we had here in 2000, you will notice that the markets had a 24, 25-month period when it first crashed down before it started to actually rebound. Now, this was a recession that occurred because of the dot-com bubble. We are not really in that dot-com bubble right now, so we can't necessarily use this as a great measuring stick. But what we can do is we can identify that some of the similarities to try to weed out what isn't occurring so that we can try to identify how long we think this recession will last. So we know we're not in a dot-com bubble. That's not the case. If we fast forward and we take a look at the 2000 bubble here, excuse me, 2008 real estate stock market crash, what you will find here is that the markets pretty much fell over because we had an issue with credit lending, with particularly with mortgages and people just getting loans that they just flat out didn't qualify for. So if we scroll down here, we'll see that the market took a 3, 4, 5 month, a pullback. We had a rebound of the 3 months. We're like, oh, okay, cool. This is a new bull market. And then that's when we had the crash. Now the difference between the 2008 stock market crash and 2000 is the long protrusion that took place here. This was a long, slow, brutal one. I mean, if you bought anywhere near, even down here, if you were trying to gauge off the bounce, you still wouldn't have gotten your money back for like 5, 6, 7 years. I mean, it was that brutal. As a matter of fact, if you tried to buy here, you wouldn't have actually gotten your money back until all the way 2012. So we're talking 10 years. Like the 2000s was a very unique recession just because of the stock mania and everyone piling in. Now, there are some similarities to this recession. What do we have here? Fast forwarding to this. All right. What we have here is we have pretty much high inflation. We have a market to where the Federal Reserve is trying to reduce housing market prices. They're trying to put suppression on the stock, not only purchases, but also the housing market. And they're trying to recalibrate by getting inflation down to like 2%. So, what caused this? Well, we already know that what caused this was the 2000 pandemic financial funding that took place with the government. They in this period between this time frame between the low here and between the highs here, they infused over $2 trillion into the economy. So what that basically means to real world people like yourself and myself is that milk is going to end up being $8 a gallon at some point if they didn't get things under control. And so while it's painful, they realized they had to do that, which is why they're raising the rates, which is why housing prices are starting to come down, and they have been for the over the past year. And yet and still, the Federal Reserve said that we still have a little bit more ways to go. They did just recently increase the federal interest rate to 1/4% here last week. So that means that they're still seeing some. Oh, there we go. They're saying that they're still seeing some inflationary measures that they think that they need to get under wraps. And so they raised it to 1/4%. And what I think is going to happen here is I think that the markets, this is a bear rally, in my opinion. And I say that purely because if you look at the behaviors of the last recessions, keep in mind, these do not happen often. Guys, if you've gotten this far in the video, I need you to understand something. Recessions do not happen often. If you take nothing else out of this video, know that they don't happen often. So when people are afraid of losing money in the stock market, a lot of the times it's because they're buying individual stocks, they're buying speculative stocks, they're buying stocks that have very poor margins. They don't have a lot of revenue. They don't have a lot of good earnings per share, and a lot of growth stocks. And those are the kind of stocks to where it's a gamble. It's like Teladoc, for example, and they're good company. I'm just using them as an example of a growth stock. And you have a lot of stocks that are like that. And so people are trying to get rich quick in the stock market a lot of the times, and the majority of the times it just doesn't work out. But if you're buying more ETFs, the broad market index funds, if you're buying the SPYs, if you're buying the QQQs, if you're buying the VUs, if you're buying those staples like Apple or the Microsofts, if you're buying the companies that you know have long tenures of proven history of making revenue and profits and growth, even though they're value stocks, you're going to make out okay. And so I'm saying all that to say is that when you fast forward here to the stock market recession here, what you're saying is that this is a classic bear market bull run up. So this is the first leg, I believe, of the bear market. And then we will have a run up, and then something will come in. It'll be, heaven forbid, a black swan. They'll say inflation is much worse, whatever they want to pull out of the hat in the news, into the news, and then things will roll over more. It has to be. You have to keep in mind that we have not had a recession since 2009. Technically 2008, yet the low of it was 2009. So if you take a look here, if we go scroll all the way in, 2009 of February 2027. Technically 1128 was the low, but it tried to fake like it was going to retest and then ran higher. So we're looking at borderline 14 years. Now the time frame between this recession and the 2008 and the 2000 recession, from the low, this is 2002, to the high here, was 5 years. When it counted the low, was 8 years. So on average we should have a recession every 8 to 10 years. We're looking at 14 years right now. So this is why I think this is not a bull market. It's not close to being a bull market. As a matter of fact, a lot of the tech companies right now are doing layoffs. Major tech companies, all the major ones, are doing layoffs. Companies are downsizing. Companies are tightening their belt because they think this is the first leg of what's going to be an actual recession. Now, if you look online, a lot of the videos, especially on YouTube, and bless all the YouTube content creators in the financial industry, but a lot of them, they create very clickbait head titles. A lot of clickbait, fear this, markets are going to crash. Very catchy titles, and it's not really geared. The video is not really geared to actually highlight that why there's a real crash, or they don't really justify it. This video, I really think we're going to have a crash. And it's because this is the first leg. We have high inflation. We have the housing market that people still can't afford. We have the Federal Reserve that has said that they're not going to lift the pressures of raising the interest rates. And we're having major tech layoffs. We're having shortages of employment, people finding jobs, of quality jobs. And so all of this is kind of like a perfect storm of showing that something is going to switch or click to where we're going to have to reset the market. Now, is this going to be painful for some people? Absolutely. But this is something that's a necessary evil, because either we take the hit now, finally, that we probably should have had back in 2020 when we had the pandemic. But I think we didn't have it back then because I think the Federal Reserve and the government knew that if we allowed things to go down there, I mean, it just would have been just catastrophic for our entire economy, probably for the world. So they had to step in there. But now the downside is that there's too much money in the systems. There's too much money in the market. So they have to now pull it out. And it's going to be painful. Companies are going to tighten their belts. Individuals are going to tighten their belts. We may have some type of black swan event that comes into the news in the next, I don't know, month to 2 or 3 months. But when that happens, you can almost rest assured that that's going to be the second leg of the recession. And that is going to be the painful one. Now, do I think that this is going to happen this year or next year? I think it's going to happen this year. And I say that because the average recession time frame is anywhere from 13 to 17 months. This is 13 to 18 months. So right now, if you count this month, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, we probably should have 16, 17. There should be another 3, 4 months of a huge recession. Now, one of the things I've noticed also that's very common with the last two recessions is this. If you take a look on the monthly, you will notice that each recession, the stock market went below the moving average on the monthly for the 20 moving average. It went above it. It went above it to make it look like it was going to be a rebound of a new to start a new high, and then it rolled over. If you go back and look at the 2000 recession, it didn't go above it, but it did have a bounce as though it was going to try to retest, and then it rolled over. What I think is going to happen is in every recession, there is a bounce. Another thing you also want to keep in mind is this. The stock market is very, very rarely ever, and keep in mind, I'm looking at the QQQs here, not the SPY. On the monthly, the stock market is very rarely under the 20-day moving average on the monthly for more than a few months. If you go back and take a look, it's under here because this is a recession. If you follow the chart pattern here, I want you to tell me where you see where the stock market was, where the on the monthly, where the QQQs was under the 20-day moving average on the red bars for more than a few months. That wasn't a recession. Here, this was a recession. This was the first leg of the recession. Then we had the pullback, and we had the real drop. Here, a few months, this was off of a rebound. If you keep looking, you'll notice, right? If you look at the entire history of the QQQ stock market, you have never seen the QQQs under that 20-day moving average ever. Until when? Now. Boom. So this is the third time, right, in the 23 years that we have seen the QQQs under the 20-day moving average on the monthly. This is why I think it's a recession. Now, here's what's weird. If you notice, you'll count 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 months, right, that the QQQs have been under the 20-day moving average. Now, what's interesting about this is that if you go back again, I'm giving a comparative analysis between the recessions so that we can try to identify how to play this. If you go back and take a look here, it rebounded and rolled over. If you go back and take a look here, it rebounded as well. First month of the rebound, I think it's going to probably retest through 27-ish, maybe through 27-ish, 330-ish, and then it's going to roll over. Now, will it roll over this month? Is this the fake out? Is it going to take another month to try to do another stretch? Is it going to maybe even try to go as high as 380 to make people really think that it's going to be a rebound and then roll over? I don't quite know. I think we're going to have a month or two. Then I think something's going to happen, and they're going to release some kind of public news, and then it's going to roll over, and then we're going to also test the monthly. Another thing I want you guys to also look out for is this. Keep in mind, if you notice the common theme here is we're comparing the last recessions to this recession. What also you want to keep an eye out is this. Every single time that the 20-day has always come into play on the rebound as well. Like you never see that it doesn't cross and stay below for a extended period of time. 3, 4, 5. We have 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 months, right? And then keep in mind, this was a fast recession. Okay, this was a very, very, very fast recession. 18 months, right? The rebound. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Even if this were a recession and we're comparing this one, this is either going to be one of the quickest recessions that we've had in the history of the stock market, or this is just probably one of the longest protracted, one of the longest initial leg downs of the stock market before it tries to rebound and then roll over. That's what I think we're looking at. So what do I want to look for moving forward? Once I think that we haven't gotten confirmation yet that this is the second leg of the crash. But if we roll over and this retest lows here, which I think we're going to in the next 2, 3, 4 months, I am looking somewhere down here into the $203, $203 support to maybe start looking at buying. And the reason I say that is because in every recession, the QQQs have fallen at minimum 50%. In the 2000 bubble, it fell like 75%, something ridiculous. If you go back and take a look here at the 2008 recession, which was a very, very quick one, relatively speaking, the high was $48, the low was 22. It fell over 50%. Okay, if you take a look at this one, 405 down to 256, it fell about 35%. So with all of the additional money into the money supply system, the $2 trillion, with the amazing, ridiculous inflation that we have, I don't think that the QQQs falling 35% and having a 15, 16-month recession is it. It just isn't. And another reason I say that is this. What we haven't talked about are the spies. This is what makes it more of a confirmation for me that I think that we're in a recession because the spies haven't yet fallen into recessionary territory. Let's look at the spy. Let's look at the spy. I don't know why I love that term, the spy, because you're spying on the total market. Look at this 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17, 18, 19, 20, 1, 2, 3, 4, 5, 6, 7, 8. I don't know how many months that is. It's like 27. I mean, it's a ridiculous amount of months that happened back in 2000. Let's go back and think of the 2008. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 months. But what you also notice with this 18 months here for the 2008 recession, they were major, major, huge red month, huge red month, huge red month, just nonstop fear falling. We had the fear in 2008. We had the fear in 2000. We do not have the fear in 2022. In addition to that, if you take a look at the stock market from the highs to the lows, 126 all the way down to 51. The stock market fell like 65%. I mean, it was ridiculous what it fell back in there. Let's go back and take a look at the 2000s. 120 to 61. It fell 50%. Okay, major major falls. From the lows. Look at this. This thing has barely budged. 472 to 348. That's it. So you think we're going to get out of here with a 25% pullback? I don't think so. There's no way. I think there's zero chance that this is a recession, that this is the bottom of a recession with the SPY only getting 25%. We're going to get some fear in the markets. And I think that the SPY is going to catch up. I personally would be looking to get something around the 280. I wouldn't even begin to try to get into the markets until around the 280, not 280, excuse me, that would be 560, until around the 230-ish range, right? That's 464, somewhere around here, somewhere off of these lows where it's tried to retest is where I would be looking at. Now, the only other thing I want you guys to keep in mind is this, as I'm kind of finishing this up, is in both recessions that we've had previously, the stock market loves to retest the previous recession support levels. And this is the scary part, for me at least. We're going to go all the way out. We're going to go all the way, all the way, all the way out. This was the 2000 recession. It fell down, rebounded up, fell down, retested those lows. Guys, I want you to look at something. 472. Look how far removed the stock market is to retest those lows. It would be down, it'd get down to 132, even retesting anywhere near the top of these mountains. $130. The stock market would have to lose basically like 75%. And you know what? I hate to say it, but this looks like that's what an actual reset would be, which makes me think at a minimum, who's to say that we wouldn't at least retest somewhere around these 228s, 200 range? I mean, how can we not get down there, right? Or at least 240s. I mean, don't even talk to me about getting near the bottom of a recession until we start getting down here somewhere. Okay, so this is why I'm like, I think this is a bull trap and a bear recession because the Wall Street, excuse me, wants to trap as many retail people as possible before they go psych and then really dump it. That's what they do. That's their job. Their job is to trap as many people as possible by drawing these things as conflictory as possible. I don't know if that's such a word, but on the charts to make them conflict, to make the bulls think, oh, yeah, it's a bull market, make the bears think, oh, it's a bear market, and then eventually you find out the one side was right. So if I'm just looking at the statistics, I'm looking at the odds, I'm looking at the history, looking at how stock markets behave during recessions, this to me screams a bull rebound in a bear market. And keep in mind, this is where you make the money. So when the stock market does roll over, in my opinion, if it rolls over 5, 6 months, 7 months, whenever that is, guys, we're gonna eat. You're gonna have to eat. When I mean eat, I mean that's the time to go in and get some QQQs. That's the time to go in and buy some Apples, some Teslas. to go in to get some, get some of those growth stocks like the Shopify's, go in to get some of the other growth stocks, buy some Microsoft, get some consumer staples, buy some Walmarts. That's where you want to really go in because that's where you're going to see the bulk of your of your profits. All right. So I do want to highlight it's never a good time to necessarily time the markets. You're never going to get the bottom. You're never going to perfectly time when a bull market is rebounding again. There are some indicators that we can talk about, but I just want you guys to be aware because I don't want you to get caught with your pants down, figuratively speaking, and then you're thinking that this is a bull market, and the next thing you know, you're sitting upside down another 60% or 50, 60%, and you're not going to see your money back for 3 or 4 years just to get back to being even when you want to make sure you have cash and capital so that when the markets do roll over, you can go in and you can capitalize. So this is my review today and what I think the markets are doing. I really hope you guys have enjoyed this video if you've gotten to the end. If you have gotten to the end, obviously you've appreciated it. So I don't think I have to ask you for a like or thumbs up because you'll probably do that anyway, and I really appreciate it. Hit the subscribe button. I will continue to make more recent, updated and more modern reviews on the stock market because I think that we are at an inflection point now to where it warrants now making videos. For this period, everything was great. For this period here, we didn't quite know what was going on, but I think now the way everything is shaping up, we're going to make some money. So make sure you guys stay tuned in to my videos to highlight what I think is going to be happening over the next few months as the markets begin to move. And I appreciate it. So thanks for watching and stay tuned. Take care.